Good afternoon. Good afternoon and welcome to the biannual Spring Symposium hosted by the CT Bauer College of Business under the aegis of the Institute for Regional Forecasting. I want to acknowledge all our sponsors for your generous support. We have 3 new sponsors this year. Thank you all for your commitment. And some of you sponsors have been with us since the inception of this series, which began officially in 1984. Thank you very much. We could not do this without your support. The Institute for Regional Forecasting, today's symposium is going to be delivered by someone who is no stranger to this audience, Bill Gilmer. Dr. Gilmer, as many of you know, came to us a few years ago. We were fortunate enough to hire him, to recruit him as he was stepping down from the Federal Reserve Bank at the Dallas branch. And Dr. Gilmer comes with a long list of publications, a stellar research record. He is well-cited, well-published, and recognized both in the academic circles as well as in the financial news media. Today's topic that Bill is going to talk to us about is, as we all know, the impact of the softening of the energy industry, the impact of that on the other sectors in the Houston economy, whether it is real estate, commercial, residential, and the multiplier effects that it has on the service sector, for instance, restaurants, healthcare, and so on. The outlook certainly doesn't look exciting or as exciting as it did a few years ago, but I go back to the statistic that I think is well worth mentioning here, which is that there are 4 billion people on this planet, 4 billion out of a total population of little over 7 billion. That's over 54% of the global population today that has no access to power, to electric power as we know it. That's a huge market waiting on the sidelines. And whether we like fossil fuels or we vote for renewables, whether energy prices go up or down, there is a huge segment of the global population that when they begin to come into when they begin to emerge with purchasing power and they come into the mainstream, the first thing that they're going to need is to turn on the light switch. So clearly this industry is not going away, and we need to think about creating opportunities as we go through this. We certainly live in interesting times today. The economic outlook for the United States, global GDP, US GDP is at historical lows, 0.5%. It's never been that low since 1982. And some economists have described the policy measures that are coming out of Washington as a search in the dark using a flashlight to highlight your toes. Clearly, some of these measures are not working. What is really problematic as we go from a problem that is cyclical or seems cyclical today to something that could become more secular is not just that GDP is slowing, the growth of GDP is slowing, but the real challenge is that our productive capacity, our productive assets that we've built might lose their value, that they might depreciate in value if they are not fully deployed. Specifically, I'm talking about the fact that as people are getting laid off, we want to make sure the skills they have stay alive, stay fresh, and that they continue to retool even if they are stepping down from the labor force. And that is where academia has a role. You knew I was going to talk about this, didn't you? The role of academia in this challenge is significant. And I say that because in the last 6 months at the Bauer College of Business, we have developed several new programs. New programs, these are not degree programs, so the time investment is not as significant, but short duration programs that you can use, that you can avail of, that you can refer others to that might be getting laid off. What am I talking about? Specifically, a 2-day course in, say, digital marketing, a 3-day refresher course in supply chain management, a week-long program in how do you start and grow your own consulting business. Those are the programs that we've created in the last 6 months. And there's a little bit of information about these programs at each of your chairs. And I encourage you to read that, to share that with people who might need these, because that's what we do in academia, is make sure that our skills stay fresh and alive. You know, the questions we've asked in our exams in economics, and Professor Papel is here, I'm sure he'll attest to this. The questions posed on exams in the economic sciences have really not changed very much in the last 50 years. What has changed is the solutions that we've created to these questions, the answers that we've created. You can be part of the group that poses questions, that stay as questions, or you can be part of the group that comes up with solutions. And that's what we do at the Bauer College of Business. Ladies and gentlemen, thank you again for being here, and please join me in welcoming Dr. Bill Gilmer.
Your phone work? Can you hear me? Great. Okay. Well, first, let me welcome everyone here. Thank you. This is another good turnout. I think we're not up quite to as many people as we had at our last symposium, but I think given what's happening in the economy, that's entirely understandable. But we have over 800 people here today. It's a great turnout, and we appreciate each and every one of you and the support that you bring to the University of Houston and to the Institute for Energy. I used to work at the Institute for Energy Analysis. This is my third institute, so forgive me. The Institute for Regional Forecasting. But let me welcome everybody. Let me start over here. And first, we want to acknowledge all of our sponsors one by one explicitly. I think IDS is over here. Is that right? And Chad Abraham. JLL, Dan Bello, stand here today. Great. Dan, good to see you. Thank you. First Southwest, Julie Peak. First Southwest is here? Good. Great. Michael Stevens Interest, one of our very long-term sponsors, and thank you again for all that you do for us. Limestone Investments. Brian Sanchez. Brian, are you here? Great. Oh, there you are. Good. Good to see you, Brian. Moody Rambin, Dan Moody III, and Bob Cromwell. Welcome. Thank you. Newmark, Grubb, Knight, and Frank. Brandy McDonald. Hey, thank you. Corinne Maker Holmes, Will Holder. Great. Houston First Corporation. David Solomon, there you are. Okay, great. Good to see all of you guys. Transwestern, Kevin Roberts. Trustmark Bank, Spence Bridges. Thank you, Spence. Comerica Bank, Jeff Payne. Hey, Jeff. Warehouse Associates, David R. David. Thank you again. And Mercantile Commerce Bank, Francisco Rivera. There's Francisco over there. Stuart Title, Glenn Clements, Larry Warren, and Randy Elkin. And on to the symposium. And thank you again to all of you for being here, and a very, very special thank you for the support from our sponsors. It's always welcome, and we really appreciate the long-standing support that we've gotten from all of the Houston community. Well, I hope you didn't come looking for a lot of good news today. After what is almost certainly the worst quarter in the history of the American oil industry, certainly the upstream part of the industry, it would be hard to promise a whole lot. You know, I think we could have a good debate right now over whether, for the oil industry, this particular downturn is not worse than anything that happened between 1982 and 1987. The current downturn has reached the point where the rig count from peak to trough has fallen 79%. Between 1982 and 87, it fell by 82%. So we're nipping on the heels. But the important difference is that between 82 and actually 1986, that decline in the rig count took 4 years. We have made the 79% decline in only 7 quarters. So this has come harder and faster than anything we have ever seen before in terms of damage to the American oil industry. On March 11th, the Baker Hughes rig count, the count of the number of working rigs in the United States, fell through 488. They've taken that weekly rig count for 67 years, and when it fell through 488, it marked the all-time low number for the number of working rigs in the United States. And every week since March 11th, we have seen the rig count set a new record up until last Friday, where the rig count settled out at 402. And so what that means for the oil industry and what it means for Houston is that we are going to start from a deeper spot, and it is going to start further in the future than we had anticipated. Our previous forecast had really assumed that the rig count would bottom out and that we would find a bottom sometime in the fourth quarter of last year. And that simply has not happened. The rig count and the work upstream has simply remained in free fall through the first quarter of the year. So the expectations, I think, for where we thought we were going to be have to be changed a little bit, because this is going to be a deeper and longer downturn than we had anticipated. You know, what we've talked about in the past is that there are really 3 big things. You might say, well, we only had 15,000 jobs last year. Not much is going on in Houston. That's not the case at all. We have plenty of stimulus at work in Houston. Unfortunately, it's working against each other. I just described what's happening in oil, number 1. Then number 2, the U.S. economy is working for us. Normally, when we have a downturn in the oil industry, that downturn is accompanied by a global recession or by a national recession. But the national economy, where probably 2/3 of our jobs have come from, broad national trends, over the last 25 years, the national economy remains a positive force for growth. And then because the price of natural gas collapsed a couple of years ago, before oil, we have this enormous construction boom on the east side of Houston, $50 billion in construction that's underway. And our argument has been up until this point that those 2 big positive forces were going to be just enough to offset the negative from upstream, and that we would avoid recession. It's a hard argument that's getting harder and harder to make because we're running out of time. And we're running out of time in the sense that beginning early next year, all of the construction work on the east side of Houston begins to wind down. So we really need to have that job growth working for us upstream to offset what becomes a negative downstream. So it's all about timing, and we're rapidly running out of time, and that's really what we'll be running through today. But when you look at the Houston economy, for better or for worse, it's always oil that makes the difference. We're geniuses coming out of the Great Recession because times were so good, but it was in fact oil that made the difference for the city on the positive side, and it's now oil that's making the difference on the negative side. If you look at the price of, think about where this bust started. prices of oil began to weaken in the second quarter of last year. But then as soon as the Saudis on Thanksgiving Day of 2014 withdrew as the swing producer, they said, we are not a cartel, we are not a price maker, we are a price taker, and we will maximize our revenues by selling everything we can. And that is the point at which the price of oil really plunged. Over last summer, the price of oil tried to stabilize. Over the April, May, and June of last year, we saw the price of oil really settle in at $50 and $60 a barrel. And as we discuss, no matter where the price of oil is, it should be about $60 a barrel. That's where it's going. And it really looked like this thing was going to end and was just about over. Then two things happened. Good news, well, in April, May, and June, we actually saw employment picking up here a bit in Houston, and we saw the Baker Hughes rig count turn around briefly. Then in July, the Iran nuclear agreement is signed, and in August, the Chinese devalue and signal weakness in their economy, and the rout is on again. We have seen some good news in recent weeks. The price of oil seems to have stabilized and is coming back. Even Baker Hughes, Goldman Sachs, the lower for longer folks, are saying that we're going to see some stability in the oil markets going forward, at least for a couple of quarters. So we'll see. But certainly, looking at the Houston economy, the outcome has been pretty much what we expected through the end of last year. If you look at 2015, those two big positive forces were just enough through the end of 2015 to more or less offset the damage from upstream oil. The numbers look bad in comparison to the three previous years. Certainly over 2012, 2013, 2014, we added in Houston an average of 109,000 a year. So the jobs machine cut off fairly quickly. And have no doubt that we have lost a lot of energy jobs in Houston. If you look at the job losses, and the first column shows the first 15 months of this downturn through the end of the first quarter, and the second column shows the first quarter of this year only. And those job losses have continued at a heavy rate right through the first quarter. But if you add up all of the energy losses in oil services, oil producers, in machinery, fabricated metal, wholesale trade, the professional services like energy, engineering that are associated, we have 60,000 jobs that are lost. And if you look at where the growth has occurred that has in fact offset this, it has been concentrated in healthcare and leisure and hospitality and retail trade, bars and restaurants, and in local government. And that is not a trend that's likely to continue. This is a modern history of Houston's job growth. This is in percentage terms. And the part we would care about begins about December of 2003, when emerging markets begin to grow rapidly. Brazil, Russia, India, and China. They put pressure on commodity prices. That pressure on commodity prices pushes up the price of oil in particular. And at that point, Houston begins to grow and grow rapidly following the price of oil. It's interrupted by the Great Recession in 2008 and 2009. We come out of that very quickly. We grow about 2.5 times faster than the rest of the country coming out of that recession, and then suddenly the price of oil falls, and the boom is basically over. This just shows you the same thing in monthly data. The red bars are Houston. That blue line is employment growth and growth rates for the U.S. economy. And as I said, Houston growing 3.3% annual rate in employment coming out of 2008 and 2009, while the rest of the country struggles along at about a 1.3% annual rate. But you can certainly see just how quickly that job growth machine shut down as soon as the price of oil fell. This is just another way, another set of data we can turn to that tells you exactly the same story. This is a purchasing managers index. There's a local purchasing managers group that surveys 70 or 80 purchasing managers here in Houston. Each month we have a comparable U.S. index. And It's set at 50, above 50's expansion, below 50's contraction, and you can see beginning 73 how Houston separates itself from the rest of the country, falls into recession, separates itself from the U.S. on this side of the recession, but then look what has happened just over the last few months. This index is really focused on goods sectors, and it tells us that there is an extensive and rapid contraction of goods here in the Houston metropolitan area. Another completely different series of data you can turn to see what's happening here is the unemployment series. Unlike this establishment survey we get the jobs data from, this is a telephone survey. And this telephone survey for the Houston unemployment rate from the Bureau of Labor Statistics tells us that last summer the unemployment rate began to turn up. It's now just about comparable to the rest of the country at 5%, but that we have added about 25,000 to the ranks of the unemployed since this downturn began. This is a very mixed bag. There are many of you in this audience who will tell me, well, this seems to be kind of an oil-specific thing. I don't think I've really particularly been affected by this yet. And the yet may be important, and it may be that some of you can slide by. Certainly, I could give you a list of 20 or 25 billion-dollar companies in Houston, Cisco, Waste Management, Men's Warehouse. They sell into national markets. United Airlines, AIG have big units here. They are not, they sell into national markets. And so what's happening here in Houston really is of limited impact. It might be that you work on the east side of Houston, where sales taxes are soaring, rents are rising rapidly, occupancy in apartments, they're absolutely jammed. Life is good on that side of town. On the other hand, the ones I would be concerned about are those that have been living off of past momentum. If you go from December 2003 to December 2016, Houston added 685,000 jobs, the number of jobs in Oklahoma City, for example. And so we had a need inside this metro area to build all of the churches and schools, all of the roads and highways and hospitals that you would need for a metropolitan area the size of Oklahoma City. And just because job growth stopped or the price of oil fell, we were still catching up with a decade of infrastructure needs. But unfortunately, we are now moving into the second year, and we may have another slow year in front of us in 2017, and much of that momentum is dissipating very rapidly. So as we look forward, it may be very difficult for a lot of sectors that have been providing job growth here to continue to do that in the future. One way to think about this, regional economists, when they think about employment, will divide things into the base employment, the basic employment, and the non-basic employment. Base jobs are those jobs in industries that can reach outside the metro area and sell to the rest of the state, the rest of the country, the rest of the world, bring revenue back to the community. We're talking about oil producers, oil services, petrochemicals, refining, machinery, fabricated metals. In the energy sector, Men's Warehouse, Cisco sell into national markets, and they drive the economy. The rest of us live in the back of the bus. The rest of us are going along for a ride with these basic groups. The laundries, the dry cleaners, the grocery store, the gasoline station, local construction companies, and most real estate, most local commercial real estate and residential real estate is going to be these non-basic industries. Now, as you look at this chart, that blue line are the base industries. They have an exciting life. Look at that. I mean, we're talking about contracting at 30% annual rates, then growing at 15% annual rates, and now contracting again at 15% annual rates. Meanwhile, always trying to catch up, you see the red line, which is the non-basic sector, and you can see that they're holding up But I think if you look at the end, you can see a little bit of a slowdown. If we look at this more closely, say, for example, starting in January 2014, you can see these non-basic follower jobs living off of it. Many of these living off past momentum have expanded about 6.7% over the last 2 years. Meanwhile, the base jobs, the leaders, have contracted by about 6.2%. And that rate of growth in the non-basic healthcare, bars, restaurants, and so on is certainly slowing and slowing rapidly. Another way to think about this is through a multiplier process. Every base job in Houston supports about 4 other workers in the non-basic sector. So as that base contracts, we can easily find ourselves with too many workers in the base. And if the history is to be around 4 or a little over 4, you can see that we have jumped up to 4.8, and that ratio is growing very rapidly. So let's talk about oil, and this is the problem, right? This is the big issue for Houston. Where did this oil bust come from? First thing you need to know is that the commodity supercycle is over. I mentioned in 2003, emerging markets began to grow rapidly. They put pressure on commodity prices, not just oil, but metals and agricultural raw materials and foodstuffs. All of those prices began to grow rapidly. They were primarily driven by these emerging markets, and we're now seeing these emerging markets begin to slow. What happened was when their growth started, price of oil shot up to $100 a barrel. And it was like a flare went up. And it wasn't just for oil, it was for all these commodities. This flare went up and said, expand, expand, $100 oil, expand. We knew that couldn't last. It would not last. The price of oil was sooner or later coming down to $60 a barrel. That is the marginal cost. The marginal technology is fracking. It takes about $60 a barrel, and the price of oil would and will eventually settle in at that $60 level. We overshot that $60 over the last April, May, and June, and when the Iran nuclear deal was signed, and when China signaled weakness on its part. And we have been in something of a rout ever since. But 2 things happened to end this. First, the signal went up, emerging markets are growing fast, and then after 2008, you have these capital-intensive industries who are able to dip in and get free money. And so you have a rapid overexpansion of all of these markets. And so while growth has slowed in emerging markets, at the same time, there has been big additions to capacity across the board. And for the oil markets in particular, don't underestimate ever the importance of these emerging markets. We find that the developed countries of the world, the developed countries are slowly weaning themselves off of oil. All of the growth over the last 15 years has come from these emerging markets. This is the latest forecast from the IMF, and the IMF's forecast, the long-run average growth for that top line for world GDP should be about 3.6%. So certainly 2016 and 2017 are subpar. The US at 2.5% growth, the rest of Europe and Japan 1% or less, and we really don't expect more than 1 or 1.5% growth out of either Europe or Japan. China was actually upgraded in the latest forecast to closer to stay right at 6% growth over the next couple of years. And anything that was lost in the global forecast to China was more than replaced by growth in the Indian economy. And the Indian economy is now emerging as a bit of certainly the star of the emerging markets. Brazil and Latin America, Brazil, Venezuela, in the middle of the recession of the century. and certainly struggling at this time, and definitely the weak factor as you look at emerging markets. So that's about demand. Demand has been soft. It's not an emergency. It's not a crisis. It's just been soft across the board. As you look at the supply of oil, however, this is the problem. This is the culprit. As you can see, the United States, over a period of about 4 years, managed to turn around 40 years of declining oil production, added 4.5 million barrels of global supplies in a short period of time, and these were the only non-OPEC additions to oil supplies in that time period. So when the Saudis turn to us and they say, Texas and North Dakota, you made this problem, you clean it up, they're really exactly right when they look at the supply side of the issue. U.S. oil production, if we are supposed to be the swing producer, the one who reduces production to clean up the problem, we only have about 1 to 2 million barrels probably of excess oil in the world to get back into balance. That's probably a narrow margin, not far to go, but we're not contributing that, and I'm sure this is moving much slower than the Saudis had anticipated. Probably oil production in the U.S. peaked at about 300,000 barrels per day last May, in May of 2015, and is forecast really to continue to decline at a very slow rate. The difference between this downturn and the downturn from 82 to 87 is really Saudi behavior, almost completely. The Saudis, between 82 and 87, the Saudis said, we are a cartel. We are going to hold the price up. Then the flare went up at $40 a barrel. Adjust for inflation, it was another $100 an oil signal, $100 signal. And oil begins to pour in from Nigeria, from Alaska, from the North Sea. And the Saudis say, we're a cartel, and every time oil comes in, they withdraw some of their production to keep the price high. And as they keep the price high for 4 years, they try to protect that price. And their production, their share of global oil production goes from 16% down to 5%. And finally, in 1986, they said, we give up. King Canute couldn't do it, and neither can we. We can't stop the oil. And they had been holding 8 million barrels off of the market, and they dumped it back on the market. This was a 60 million barrel per day market. They dump 8 million barrels into it, and it takes over a decade to work off that glut. This time, early on, the Saudis said, look, there's about 1 million barrels out there. Somebody has to take it off the market. It's not us. We learned our lesson. We're not doing that again. It's up to Texas and North Dakota. And that's what we've been struggling to do since that time. You throw in an aggressive new crown prince trying to win his spurs, has taken him off into some military misadventures in Yemen. He's managed to turn the Iran nuclear deal into a Sunni-Shiite confrontation, and it adds a whole new layer of political risk and testosterone in this that probably didn't need to be there. But along with the economic risk, we now face some significant political issues as well. But the greatest oil boom is over, and indeed this may very well be the greatest oil bust. If you look just in terms of lost capital spending, in current dollars, all adjusted for inflation in 1982, we were spending less than $100 billion. This boom peaked at $300 billion, and we may well have lost well over $200 billion by the end of this year. CapEx may be down by twice everything that was being spent in 1982. And certainly as you look at the rig count, again, we're right nipping on the heels of the worst percentage decline ever. This is a great picture. This is a counter-cyclical industry in Houston. This is the Ritchie Brothers auction yard at Delta 8 and Highway 59. They handle surplus construction equipment and trucks. And last year they had their greatest year ever at their Houston auction yard. 20,000 lots, $58 million worth of sales through that yard. Let's think about recovery and what recovery has to look like. First of all, as I said, I don't care where the price of oil is, it's going to go to $60 a barrel eventually. And if we just rank the sources of oil in the world, starting with the onshore Middle East, the offshore shelf, as they get more and more expensive, if we want to produce 90 or 95 million barrels a day, eventually we need these high-cost sources, and those are, right now, the marginal sources are fracking and the Canadian oil sands. So eventually, the price of oil comes back to that level. So, and we can actually see that by looking at another source. As investors have valued the stock of American oil producers, they must have an implicit assumption about the oil price built into them. Goldman Sachs actually solves for this on a regular basis. And you can see that even as badly beaten down as those producers have been, the assumption is that the price of oil is about $60 a barrel. During the last quarter of last year, the first quarter of this year, during those really bad times when oil fell under $30 per barrel, it fell to 56, but even now it has bounced back right to that $60 per barrel level. Where our prior forecast went wrong was by assuming that things would bottom out in the last quarter of last year. This chart just compares the 2008 and 9 decline in the rig count and that oil bust with this one. We were right on track to turn around over last summer and late last year, when again, things didn't work out with the Iran nuclear deal and Chinese weakness. And the result is, you can see that while recovery was fully underway in 2008 and 2009, we have continued to decline well under that prior assumption of a rig count bottoming out in the fourth quarter, and are now down to 506 rigs. If we want to know about recovery, we're going to have to sort of assume some things, maybe look at some history to help us with those assumptions and do a little modeling. But we need to know, when will the price of oil hit bottom? That might have been the first quarter of this year. It may be that that was the definitive bottom in oil prices, and they will begin to rise from here and moving forward. If that was the case, then when will the rig count turn up? Probably about 2 quarters later. And if that was the case, then when does employment in Houston begin to turn up? And the answer is about 2 quarters after that, or probably early 2017. And then how high will the rig count go? Well, it's not likely to go back to 2000. That was $100 oil. We're going to see $60 oil. And we're talking about an industry that's going to be the marginal industry. We're talking about fracking being the marginal producer, so every time a surplus of oil arises in the world, fracking will be up and down with that surplus. So it's going to be a cyclical industry. So we might assume it's going to be 1,600 rigs or 1,500 or 1,300 at the new peak. How long does it take to get back to that prior peak? Well, usually the history says about 8 quarters. Here are some models that we might look at. These are 4 recoveries in the rig count that we've seen in the past, for example. It's not going to be 1982-87. I described what the Saudis did in 1982 to 87. They tried to hold back that tide of oil. It didn't work, and they dumped 8 million barrels on the market. It took us a decade to work our way out of that hole. And they haven't done that this time. Saudi behavior is different. It's not likely to be 2008 and 2009. We got that was a 3-quarter downturn in the oil industry, and what brought the oil prices back up was strong growth in emerging markets, and we don't have that working for us now. It took a matter of months before the price of oil was back up at $80 to $100 per barrel. So maybe we look at this 2001-2003 period. That 2001 to 3 period was a U.S. recession in the fall of Enron in Houston, and then 97 and 98 was the Asian financial crisis. So if we go through and ask those questions and focus on, say, 97, 98, 2001, 2003, 2 quarters till the rig count bottoms out, after oil prices make a bottom, energy jobs come back about a year later, and 2 years later, we've restored the rig count to previous highs. The actual assumptions, part of them assumptions, pure assumptions on my part, some of it, particularly the energy jobs part, come out of the model, but you can see the assumptions that are going to be made as we try to assess what happens to Houston in the event of recovery. So we're trying to put these rigs in Midland, now stacked by the side of the road, back to work, and we're going to assume oil price bottoms out sometime across this year with our high, medium, and low scenario, a rig recovery that comes at 1,650 or 1,500 or 13 rigs, and then the return of energy jobs based on modern behavior and modern productivity of the rigs. And these are the assumptions as we try to figure out what's going to happen here in Houston. This is what happens, one to the rig count, and on the right, the return of energy jobs. And the timing of the return of these upstream jobs is critical because we're winding construction down on the east side next year. And if we did not see that first quarter as real bottom in oil prices, we're going to have a long period where upstream is not working for us, and all of that construction work is rapidly winding down. Now, I promised myself I know we've gone over this just about every time I talk, but I will never give a talk in Houston without reminding everybody that no one can forecast the price of oil. One of the things that agricultural economists know is that they have had deep futures markets in wheat, soybeans, corn for decades. And the best forecast for price you can get is the futures market, the very best. It beats all the analysts, it beats all the statistical models, averages of the statistical models, averages of the analysts. It's the best you can do. That said, it's horrible. It can barely beat a random walk. It can barely have more information than a naive forecast that tomorrow is just like today. But it beats everything else, and it actually has a little bit of information. And how much information does it have? You can actually solve, for example, by asking for confidence intervals. If you use just the futures market, our very best forecast, what it means is that by the end of 2017, the price of oil will be somewhere between $20 and $80 a barrel. And by the end of 2016, 20 and 80, and by the end of 2017, somewhere between $20 and $100 a barrel. So there's no information there. Not much. I mean, you wouldn't pay for this forecast, I hope. But then there's people walking down the street every day telling you, well, I count all these barrels this way and that way, and I know the answer. Well, they don't, unless they have some secret. But I don't know. If they really had that secret, why would they tell you, right? Why? I'm going to assume the U.S. economy continues to work well. I'm going to assume Men's Warehouse and Cisco and United Airlines all get the benefit of a rapidly growing U.S. economy. That's a big risk to this forecast, and you should understand that. But I think there was a narrative early this year that the U.S. economy, well, actually the global economy was weak. Emerging markets had all these financial problems that were going to crop up. We would have a global financial crisis, and the U.S. economy would be sucked into recession along with the rest of the world. But that narrative is gone now. We don't believe that, but there's still this drumbeat, if you watch the CNBC or Bloomberg, of looming recession out there. And I think that's just simply wrong. I think part of it is Wall Street could see these coming interest rate increases, And they're addicted to low interest rates, free money. Who doesn't like that? And it was sort of like, I think they were just trying to tell the world they know they need to go to rehab, but they just don't feel good yet. You know, we're not up to it. Maybe a few more quarters and we'll feel better. And it is simply wrong. So we have positive outlook. In fact, there were a number of banks and investment houses that all carefully reworked their probability of recession models, and all of them were showing these increasing probabilities of recession. If you look at probably the best academic model for probability of a recession, not built on Wall Street, it basically says the probability of recession in the United States has been 0, or less than 1%, since we came out of the Great Recession. I know many of you are interested in interest rates, so I will just mention that. I think if you again turn to the futures market today is saying there is virtually no chance of a rate hike before December 2016, and there is really not even a one increase of 250 basis points that is priced in before the end of 2017. And I'm not sure this is economics or whether people have just figured out that the chair of the Federal Reserve has no stomach for raising interest rates. You can go back to her speeches before she became chair, and over again, she argues for pushing for inflation and risking inflation because of the benefits that spill over into the job market. And so I think sooner or later we're going to have 3 to 3.5% Fed funds, 4 to 4.5% 10-year Treasury, but I'm not sure when that happens exactly. Downstream, really the only message I have about downstream, we'll run through slides, but the important point is that it has been an incredibly important offset in terms of creating jobs in East Houston, but we're coming to the end. Those large construction jobs have an expiration date on them. Some of it recently has been about low oil prices. The processing end of the industry thrives on low oil and low natural gas prices, and based on solid margins, we are seeing refiners contribute some construction on the east side of Houston and up and down the Gulf Coast. This is primarily a natural gas event. This looks exactly like that hockey stick that I showed you earlier for oil, where we reversed all of the decline in production in a very short time. The difference is that it comes earlier. We wrecked the natural gas market in the United States between 2011 and 2013. We learned to frack natural gas first and oil later, and the price of natural gas has been very low since that time. That should be, I don't know how many times I've changed that slide, but we wind up with a mix of 164. The top line is right, $164 billion in construction based on cheap energy on the Texas and primarily on the Texas and Louisiana Gulf Coast. It has been, the United States is blessed, North America is blessed to have large quantities of natural gas. The rest of the world, by and large, is forced to turn to oil. So for a wide variety of products, even for heating for steel and for forging, for example, we can use natural gas and not $100 oil. Natural gas is priced at the equivalent of about $20 per barrel. So if we're making petrochemicals, we have the opportunity to do that using a very cheap feedstock. And that is exactly what we have seen. The margins have been wonderful in ethylene, for example. But if you look at what we're going to do with that natural gas, we're going to make petrochemicals. One European company after another is moving its operations out of Europe because there they have to use oil to make these intermediate products for plastic and synthetic rubber. And so we find the Swiss, the Dutch, the Germans moving their petrochemical plants to this privileged place where we can use natural gas and natural gas liquids to make these petrochemicals. So we have $50 billion that have been underway in this area. Ethylene, 4 big ethylene crackers lead the way in terms of what's happening. We have one big LNG export facility in Freeport here in Houston. I was just over in Baton Rouge. They're talking about potentially 8 LNG export facilities there. I don't think that will happen, but it is ground zero for the LNG export business. But again, a wonderful event, a temporary event. Most of the benefits of this expansion are in the construction phase, and they do not leave that many permanent jobs behind. There are a lot of projects that have been proposed, many projects that are still being talked about. I think the INEOS, one more big ethylene project, will probably go forward. It's just waiting for board approval. The Dow project will probably go forward. That big fund, Connell, which is a Chinese plant, is a proposed methanol. I don't think anybody knows exactly where that project stands. But really the point from this list is that, yes, there's still work that might come on board, but replacing $50 billion would be a very, very tall order indeed. It's been a very important counterweight to those upstream losses, but it's going to expire soon, and that's why the timing is so important at the upstream. We had previously had this assumption that this downturn in oil would not be as long as it is. It would not turn into the second longest downturn we have ever seen in the oil industry. So we're running out of time, and that's the reason we went through that tedious business of counting. Well, if the price of oil turns in the first quarter of this year, then it'll be the middle of this year before the rig count turns up, and early in the first couple of quarters of next year, upstream turns up, because we're going to see that work downstream working against us. And so if you go through those calculations, remember what I said when we began, was that we necessarily begin this recovery from a much later point and from a deeper point. So if you look at the employment projections, for example, the high forecast assumes that we made that turn in the first quarter of last year. We previously had been forecasting plus 10,000 jobs for Houston this year, and now it looks like that number will be maybe minus 10,000 jobs. Then, if you look at 2017, that 2017 had previously been where we were expecting that definitive turn up in employment in Houston. It's now very difficult to see because of the length of this downturn and its depth that 2017 is going to bring a strong upward turn. And then we find the turn later in 2018. And as you go to the medium scenario, then we have, and I want to emphasize this is a hypothetical recession 18 months off into the future, but at the same time, you see the possibility of a 1% job loss in Houston in 2017 before we turn up in 2018. And the low, well, here we have in 2017 a 2% job loss. Maybe the best way to think of this is maybe there's a 30% chance that the high is right, 50% medium, 20% low, and then we're right at this 1% job loss in 2017 using that kind of probability-weighted approach. Now, I want to emphasize, as I said, this is, we're going to find out soon whether this oil price sticks, and we will know whether we're going to be moving from high to medium. But even under the worst circumstances, this is not 1982. Remember, in 1982, we lost 225,000 jobs over a 5-year period. It was half the size it was today. So today, to match 82 to 87, we would have to lose 450,000 jobs in Houston to have a comparable event. And we're certainly not talking about anything like that. At worst, with a poor recovery, deliberately made to look bad, perhaps a 2% decline in 2017. Well, let's talk for a few minutes about real estate. This is a great example of a non-basic industry. Non-basic, we're talking about a back-of-the-bus industry. And it's not just all of those non-basic industries. It's back of the bus in the sense that you're not the driver. Way up in front, Exxon and Shell and Men's Warehouse and Cisco are all making decisions. You're trying to make decisions about your business, but you can't really see where they're going or how fast they're going, or, wait, did they just turn? Why did they turn? Did the bus just break down? What happened up there? And it's very hard to make those decisions from the back of the bus, and the timing gets off, and real estate is a great example of exactly what can happen when you don't understand and get surprised by what is happening up front. We have really two markets in commercial real estate that are facing some issues. One in office that was a mistake made well before this downturn began, and then apartments just looked at the wonderful rents they were enjoying and the high levels of occupancy and decided they would just keep building until they could see if they could wreck that or not. And apparently there's a good chance they have done some damage. Single-family statistics look good for the metro. We're going to start there. But if you get beneath the surface, you can see there's some potential problems, especially if this stretches out for 2 or 3 more quarters, another year and a half. Then there are some potential weaknesses in that single-family market. Industrial and retail are in good shape, but again, because of the slowdown, there are some real cautions, I think, about both the west side and the east side as we go forward. These are existing home sales. In Houston, they turned flat. If you just look at sales, they turned flat in 2012. They turned flat in 2012 because we ran out of anything to sell. There was no inventory left. Inventory went down to 2.5 months. And since 2014, they've remained flat, but part of this has been soft demand. And so we have seen continued flat sales, which looks like nothing has changed on the surface, where I really don't think that is the case. Certainly the market is tight across the metro area for existing home sales. We're back up to close to 4 months supply. 6 months is normal, still a very tight market. And the extraordinary thing in this picture is on the right is those price increases. Nearly double-digit increases for 3 years in a row, 9.4% for the median price. And those double-digit increases, we don't live in San Jose. What happened here? And you can see that those prices are flattening out. And we'll talk about what really has been some inability to get lots on the ground in the right number, and then the right kinds of lots on the ground at the right time. But let's look, for example, at the ship channel cities over on the east side. Sales are high, things are soaring, life is good, and the inventory remains very low in Baytown or Channelview or Pasadena. All the statistics are good on that side of town. But if you come closer in, if you take Rice Military, out Washington Avenue, the Heights, Galleria, all of these areas they're added together here, but they really look pretty much the same. And that is two pieces of bad news. Sales have softened significantly, and if you look at the inventories in these areas, combined areas, the inventory's up above 6 months now. And that trend of soft sales and growing inventory does not portend well for price. Price is holding up so far, but only so far, and you really have to ask if there's not some damage to be done ahead. South of I-10, exactly the same story. This is the Memorial, and then out through the Energy Corridor area, you can see exactly the same story of softening sales and rising inventories and prices that so far are holding on. But again, I think it's only a question of time unless something turns. And certainly the one area that you can find in full retreat is that the Exxon bubble has ended. It is over in the woodlands. And if you look at those prices, those are median prices that were pushing $400,000 are now pushing $300,000 from above. So here is the inventories are not above 6 months, but they're clearly on the rise. And if you go through the rest of the metro area, South Houston, as you might expect, is actually fairly strong, but spillover from the ship channel areas. And north of I-10 in Spring Branch, it's showing some weaknesses. And then if you look at Katy, to my surprise, Katy was doing very well. Inventory's low, sales are up, wonderful statistics. And I have to wonder if a lot of people didn't just go look at the woodlands, shocked by the prices they saw there, and said, you know, they just built us this nice grand parkway. We can drive to work from Katy. And I have a feeling that has been worked to the advantage of Katy. The distant suburbs, well-priced, Kingwood, Pearland, Sugarland, they're all doing extremely well with very low inventories, and the statistics look quite good. If we talk about that increase in prices that we saw, it is rising land prices that started about 2013 that drove most of those increases. I know there were a lot of construction cost issues. You couldn't get framing crews, you couldn't get roofing crews. Material cost was up. But if you look at these numbers from the Lincoln Institute of Land Policy, after 2013, the typical new home price increased by $40,000 in Houston, largely because of the price of land. And it's been a problem in the big sense. The Texas affordability, the Houston growth formula, it starts with cheap and abundant land, low home prices, and a low cost of living. This is the Wells Fargo Affordability Index, which says basically if we took the median income household, I'm sorry, that's wrong. What they do is they say for a 30-year mortgage with 20% down, current interest rates, what fraction of the community, of the households in the community could qualify for a mortgage? And the answer in Houston turns out to be that we're right at 60%. But these are the biggest metros in the U.S., just listed from top to bottom. And I think it's a little surprising. If you look at the ones that are in red, and remember this is a combination of home prices and income in the area, you will see that more affordable places include places like Washington, D.C., Chicago. Chicago certainly surprised me. Washington, D.C., Philadelphia, Atlanta, and Phoenix. So we're losing that affordability edge and have lost it to a considerable extent. What happened was we squeezed these buyers out. What happened is our new home market suddenly just made a tremendous shift. We were building homes, we were developing lots. 2015, we delivered a lot of lots finally, but they were lots for high-priced homes. We were building those homes for energy executives and for high-priced technical talent moving into Houston, $400,000, $500,000 homes, and suddenly that is cut off, and the market that is left is all of those people that we cut out. Every time that affordability, there are 2.3 million households in Houston, and every time that index ticks down 1 percentage point, it cuts 23,000 people out of the market that can no longer qualify. And so the market has shifted now back to those lower priced homes where we're talking about family incomes of $60,000 and $70,000. And I think the question for Houston is whether we can really still develop land and deliver lots and homes for that income segment or not. But the market has changed, and it's no question, there's no doubt as to why these permits have staggered. It's because we have the wrong lots and the wrong houses on the ground for the market as it has evolved in this big slowdown. Multifamily finally overdid it. Multifamily goes into this downturn. We can really start this about the second and third quarter of 2014. The statistics, record high rents, very high occupancies, but we just keep building keep building apartments. My colleague, Adam Perdue, did much of the work on this and did these charts. And basically he went through and he looked sort of at 1 mile square areas in the Houston metro area. And if there were 5 apartments of whatever class, 5 apartment complexes of whatever class in that square mile, he just called that a little market. And the blue areas you see are areas that are markets, but have had no building since 2013. Now, if you look at the red ones, that's where we have been building since 2014, and since this thing came on the horizon. And if you look, much of it is around the edge, around the periphery on the west side, and that's where the metro area grows. So you would expect to see all those apartments around the Grand Parkway. But look what we did in the center of Houston in terms of construction and continued construction, this big blob that runs from downtown through Montrose out through the energy corridor. There's always room for another good idea in apartments or anywhere in commercial real estate. But if you all have the same idea at the same time, I have to wonder. And you can illustrate this. Here is that section of where we saw all of that building. And where you see the light orange, starting in early 2014, this is just starting in 2014 if it's red. The lightest areas show where since early 2014 we have doubled the number of apartments in that area. The intermediate red color says that since early 2014 we've tripled the number of apartments in that area, and if it's dark red, we have quadrupled or more the number of units in that area. So we have done some damage, and if you look, the continued construction, these are Bruce McClenny's numbers from Apartment Data Services and his definitions, but a project remains leasing up for the first year and then is classified stable after that. And if you look at the stable units, 91.3% occupancy, still a very, very strong number. And rents holding up. If you look at what's in lease up, however, occupancy for these first year are only 26%, and overall Class A is 80.5%. And we have 25,000 units still in the pipeline, and there are still lots of units that are being permitted at the pace of about 1,000 per month. So, and we know that rents are under substantial pressure. Almost anyone now can get 2 months free rent, and if you bring your realtor with you who made the reference, they'll give you another month for that. So effective rents are down almost 25% before you start. So far, it's a Class A problem. That's mostly where you build new units, right? Most of them, at least, Class A. And so as we have seen this pressure rise, occupancy still and rents are still holding up in B, C, and D. But you know that cannot last, right? Those bottom of the line A units are going to start cutting rents. They're going to drop amenities. They're going to defer maintenance. And the first thing you know, they're Class B. And the Class B falls to C and the C to D. And so this whole thing will cascade through, and the issues at the top of the chain will quickly work their way through the system. We have cut permitting back by about half. Finally, it took until early this year for that to happen. And the vacancy rates we have seen before. Even this projection uses our lower employment forecast and the lower population forecast that go with it. So this includes that. So the vacancy rates just don't look that bad, even compared to recent history. But what I would be concerned about if I was looking at pro forma for some of these apartments would be more on the rent side and what their expectations were for rents, and maybe even looking at what they paid for land in some of these inner city projects. The office market, to change the subject. I think after looking at the office data, Adam suggested that we now have a new leading indicator for the Houston economy. Anytime the office market delivers a big slug of office space, we're about to have a recession. That has been the history, and most of the damage this time was delivering 14.5 million units, 14.5 million square feet just before the bust began in 2013 and early 2014. Now, a lot of that space, yes, it was for corporate headquarters, it was for campuses, it was otherwise pre-leased, but you knew these campuses overbuilt. They were putting much of that office space back on the market anyway. When they moved in, they left space behind. Yes, it was older space in many cases, but it was space. And as a result, it has opened, under all kinds of terms and conditions, it has already opened the door to 10 million square feet of sublet space that has come back onto the market. And so we're in an all too familiar cycle of deliveries. Again, using the new employment numbers, Adam came up with this forecast in terms of vacancy. And remember, this is vacancy for the metro area as a whole. Many of these offices well occupied as it is. But it is not a horrible picture. It looks like something like what happened in the 2002 to 2004 period. But vacancy jumps up to around 16% in the high forecast and as high as 17 in the low. However, one of the things you should take away from this is that when you deliver 14 million square feet of space, no matter whether it is pre-leased or not, it is going to run vacancy up. The correlation you see here between deliveries and vacancy is quite strong. And you should be very careful when you think about that 16% vacancy, because that's an average across the area. Adam again did this square mile by square mile analysis and looked for square miles that have 5 office buildings in them, an office market, all classes. And what you see here, these dots, the red dots again, are places where the vacancy rate is already above 16%. Some of them obviously in lease-up, and some of them out here around Greenspoint, for example, the older space is left behind. But these markets, the lighter they are, the lightest ones are only 16%. Out here where you see the dark red, these buildings are 30% vacant. So it is a local market, so be very careful in thinking about where you stand. The industrial market is in fine shape. When you think about the market, you need to divide it east to west. Here's a map of all of the deliveries of industrial space since 2010. And on the west side of Houston, you have the oil industry. You have the American oil industry that is located out there. You remember Old Hardy Street was, in the old days, was the machine shop row in Houston. That grew out around Delta 8, and so now as you go around from Intercontinental around to the Energy Corridor, that is the industrial belt out there. So all of the upstream machinery and fabricated metal is on that west side of Houston, and it is all suffering. The other thing you find on that west side and north side, because we're a port city, everything that flows into Houston for distribution purposes comes in from the north. If you're UPS or Walmart or Target or whoever, you find yourself a nice a warehouse out where 2 freeways cross, and you break it down into smaller trucks and distribute it through the city. So you have all of this distribution and logistics stuff. That has been doing well, but remember, it may well be living off of momentum, too. It's done well up to this time, but as population and employment growth slow here, the need for that kind of space is going to slow as well. What we've seen in recent years is about 80% of all the industrial development until recently has been on the west side. And now with all of these plastics plants going up, the need to distribute all of these plastic pellets to the rest of the state, the rest of the country, and the rest of the world than the industrial space has been in demand. And so what we have seen is that in 2016, probably half the deliveries in industrial, including under construction, will in fact be on that side, on the east side. East side vacancy rates are down. The west side is up. The west side vacancy rates are up, not serious condition. And if you look at the pipeline, there is nothing threatening in that pipeline. But the warning comes from have those retail activities in fact been living off of past momentum where we're trying to break down for logistical purposes. Rents have paused on the west side and the north side and actually continue to rise in the east. And retail is basically a pretty good story as well. There is nothing in the pipeline that threatens retail. I have read several places about how disciplined retail has been in this expansion, and that's the reason they're doing well now. Well, that discipline was imposed in about 2006 and 2007 when they delivered 16 million square feet of retail space just in time for the Great Recession. So much for discipline. That was that's called shooting yourself in the foot. But during that long period of too much retail space in most of the city, retail was sort of relegated to going out around the Grand Parkway, looking for those housing developments, and putting grocery store anchored strip malls in. And that was the retail story for several years. That is changing now. We are beginning to see more diversity, and as I'll show you, rents are rising, vacancies are very low. It's just that they have come just in time for the latest downturn. Here, question is, how are retail sales doing in Houston? This is the city of Houston's retail sales tax collections. And you can divide, we know they're down about 7% since this bust began, and you can divide that decline into sort of two parts. Business pays much of the sales tax, actually called the use tax, but collected under that sales tax name. The use tax much of it's paid by business, and much of it's paid by the consumer when you and I go to the grocery store or to the department store. And that's the process we're most familiar with. And if you look, almost all of the decline for the city so far has been in business tax collections. We're seeing retail collections continue to grow, but only at about a 1.7% annual rate. Just a couple of years ago, the retail part of this and associated services were actually growing at 3 to 4%. So there has been a significant slowdown in retail here, but absolutely nothing that has gone into reverse. Rents and vacancy are in good shape, and to the extent we could do so, we took the forecast, we took the coming pipeline, we allowed for our employment forecast, for our population forecast that goes with that, and what's in the pipeline for retail actually looks like retail just continues to fall behind population, and that those rent and vacancy figures, if anything, should probably continue to tighten even under this lower revised forecast that we have now. So commercial real estate, by and large, except for office and apartments, pretty good shape. I think we have to sort of redirect our efforts a little bit in residential. If we could just figure out how to help those people that we squeezed out of the market with those double-digit price increases, that might be where the market has in fact moved. Unfortunately, the forecast is down, and I think that's almost inevitable given what happened to the American oil industry. Let's hope the U.S. economy continues to work for us and that we can just gently and safely wind down all of that construction on the east side with oil prices holding up for us. So thank you guys for coming today. You've been a great audience, and